All right, let's get right into it. We're going to tackle one of the biggest questions in trading. What is the best time frame to use? But here's the thing. The secret isn't about picking just one. It's all about learning how to make them work together to see what the market is really trying to do. So let me ask you this, and be honest. Have you ever had this happen? You spot a setup that looks absolutely perfect. Everything lines up, you get in, you're feeling good, and then bam, the market just does a complete 180 on you, and you're just sitting there thinking, what in the world just happened? Well, I can pretty much guarantee that in most of those cases, the culprit is actually super simple. You totally missed a giant clue. Sitting on a higher time frame, you are so focused on winning that little battle, you didn't even realize you were on the wrong side of the war. And that brings us to something I like to call the one chart trap. It's this habit we all have of getting tunnel vision, just staring at our favorite entry time frame and completely losing sight of what's happening in the grand scheme of things. And you know this is a really fundamental mistake. The big powerful account-making moves, they're dictated by the larger market structure. We're talking the weekly, the daily charts. You can think of it like this. The lower time frames, they're just the ripples on the surface. But the higher time frames, that's the tide. And you do not want to be fighting the tide. So how do we actually fix this? It's simple. We have to flip our whole process upside down. Instead of starting small and getting lost in all that noise, we're going to start big. And this is the whole idea behind what's called top-down analysis. To put it simply, top-down analysis just means you start your work on the big picture. Charts like the weekly or the daily to figure out which way the wind is blowing. Then you methodically work your way down, chart by chart, to find an entry that goes with that overall direction. The whole point is just to keep you on the right side of the market. It's really cool how this completely changes your whole perspective. Honestly, the best way to think about it is like you're putting together a puzzle. One single piece doesn't really tell you anything right, but when you start connecting them all, from the big border pieces on the high time frame down to the little details on the low time frame, a really clear picture starts to form. If you miss even one of those pieces, you could completely misunderstand the entire image. Now, this isn't some rigid one-size-fits-all rule. The specific time frames you use, that's going to depend entirely on your personal trading style. As you can see here, a swing trader might use the monthly chart for direction and a 4-hour chart for entries. A day trader, on the other hand, might use the daily chart for direction and the 5-minute for their entries. The specific charts change, but the core principle that stays exactly the same. Okay, so let's get practical. How do you actually do this? We can break it down into a really simple 3-tier framework. This is basically your step-by-step process for analyzing any market. Anytime, think of it as a simple 3-step process. Step 1, use the high time frame to figure out your direction. Step 2, go to the mid time frame to find your potential setups. And step 3, zoom in to the low time frame to pinpoint your exact entry direction. Set up entry. Let's look at each one. So, first up, the high time frame. Your only job here is to figure out the market story. You're like a detective. Where is price coming from? And where is it most likely trying to go? You're not looking for a trade here. Not yet. You're just identifying the major trend, marking out the big, obvious levels of support and resistance, and figuring out the most logical target. Okay, so once you have the story, you drop down to your mid-time frame. Now you're looking for a specific chapter that fits into that bigger story. You're hunting for high probability setups, things like a pullback into an order block, or a nice fill of a fair value gap that line up perfectly with that direction you already established. And finally, we zoom all the way into the low time frame. This is all about execution. You've got your direction, you've got your setup, and now you just need that final green light. You're waiting for that last little confirmation. Often, it's a tiny shift in momentum, what some traders call a change of character. to really nail your entry with precision. And of course, clearly define your risk. Okay, this next part is maybe the single most important rule in this entire process. Seriously, if you take only one thing away from this whole explainer, please make it this. It's what we call the alignment principle. So, what happens when you do all this work and the charts just don't agree? You know, the daily chart looks bullish, but the 4-hour looks bearish, and the 15-minute chart is just a choppy mess. What do you do when the story doesn't make sense and the puzzle pieces just don't fit? The answer is so simple: you do nothing. The trade is not there. It doesn't exist. If your time frames are not all singing the same song, there is no high probability setup. The market is basically screaming at you that it's undecided and trying to force a trade in those conditions. That's probably the fastest way to blow up your account. And that right there illustrates the real superpower of top-down analysis. It's not just about finding the A+ trades. It's about helping you avoid all the bad ones. That discipline, the ability to just sit on your hands when things aren't perfectly aligned. That's what separates the pros from everyone else. So, after all this work, what's the big payoff? I mean, why go through 3 different layers of analysis for every single trade? Well, the answer is all about unlocking trades with massively higher reward potential. I mean, just look at this comparison. If you're only trading on the 15-minute chart, your logical profit target is probably the next little 15-minute high, and that's fine. It's a small profit. But when your 15-minute entry is perfectly aligned with a bullish daily trend, now you have a real reason to aim for much bigger targets, like a 4-hour swing high, or maybe even the daily high. Your profit potential just explodes. And that right there is the huge mindset shift. You stop being just a pattern hunter, randomly clicking through charts, looking for a familiar shape. Instead, you become more like a market detective, patiently and methodically searching for that one perfect setup that fits beautifully into the grand story being told on the higher time frames. So I'm going to leave you with this one question to think about when you open your charts. What are you really looking for? Are you just focused on the noise of the next 5 minutes? Or are you trying to catch the next big move? Because using this top-down framework, that's what helps you tune out all that noise and focus on what really truly matters. This image is for illustrative purposes only. To gain a deeper and more structured understanding, join my community, where you will have access to comprehensive materials and detailed guide